Just spoke with a senior Treasury Department official. Here's what I can tell you, a lot of clarification on this bank CEO call, which is causing some anxiety and a lot of questions today. The Treasury had no concerns going into this call about liquidity whatsoever. The call was intended to be a check-in with major bank CEOs, of which the Treasury Secretary speaks to regularly, about everything going on in the economy, the shutdown, trade issues, Powell, markets. In fact, no reason to believe that it was about anything relating to lending and liquidity as far as any concerns out there, and that the Treasury Secretary heard exactly what he expected to hear on that front, which is no reason to be concerned. In fact, the senior Treasury official tells me the headline on the bank call should have really been more about the economy. And the message from the bank CEOs is that the economy in the U.S. is looking quite strong. Concerns about global issues like Europe, like China, but that the Treasury does see a disconnect between the markets and the economy. And according to the senior Treasury official, the bank CEOs confirmed this view, and that's really what the call had to do with. As to the question of why release a statement about liquidity and lending when nobody was asking questions or worried about that, senior Treasury official tells me it's just in the interest of full transparency. Things are okay. There were no concerns going in. Just wanted to check in about some of these market fears around the economy.
So everything's super positive and the tone of the call was super positive. Does this Treasury official therefore admit that there was a mistake to release this statement at all? Because the reaction on a PR front, on a comms front, has not been, oh great, everything's good. It's the same as if the defense secretary had come out and said, guys, I've spoken to all my submarine captains and all of them say everything's great. That causes fear.
I think it was just full transparency, and I think if maybe the point was made to me that if this wasn't released, then you'd have people wondering, where's the Treasury Secretary on some of these issues that were all out there, shut down, Powell. It's a lot coming to the markets at once. And with the NASDAQ in bear market and stocks coming off their worst week in 10 years, it was just a routine check-in, and mainly about the economy. I do think there's some admission in the Treasury that it should have been about the economy and not led with those liquidity concerns. I think the Treasury is just used to checking in on liquidity and bank lending and making sure things are smooth. Also want to bring you some other headlines from the senior Treasury official relating to Powell and that tweet that Secretary Mnuchin put out on Saturday night, quoting the president. I asked, why didn't the president just tweet it himself if he has no intention of firing Powell? Treasury Secretary says this is a direct quote from Trump. They were on, the Treasury official, says this was a direct quote from Trump. They were on the phone together that night, relaying back and forth the direct quote and the tweet, and that as far as the Treasury is concerned, the president has no intention of firing Jay Powell. And in fact, Williams did a good job clarifying on CNBC when he came out the flexibility of the Federal Reserve.
I think this is all important because there was some fears out there of does the administration really have their handle on this? And what we're really pointing to from your conversation is that there was a bit of a PR comms issue on how they worded the statement, as opposed to whether this was just a really crazy thing to be doing at all. The bank CEO call in general, and whether there was some other wildcard questions. Were they talking to the bank CEOs about firing Powell? That doesn't seem to be the case.
Maybe spun the wrong way and definitely interpreted the wrong way from investors and from markets. It was just an effort, according to Treasury, to be transparent about checking in on some of the big issues that we're all talking about every single day in the markets and the economy.
And on the topic of liquidity, I just want to bring up specifically some data, because there's two big differences here. The one question is, are banks liquid? Is there any threat of a 2008 Lehman issue? And then the other question of, is the market as liquid as it was? Firstly, on the banks, we have some stats comparing to 2010 to 2018 showing how much more liquid the banks are. This is data from Goldman Sachs. Large cap banks got 39% more liquidity. Trust banks, regional banks, even more than that. This is defining liquid assets as cash deposits and central bank US Treasury holdings. So banks are far, far more liquid. There's no need to even have a call on that topic. What about the market? Is that more liquid? Also, the Goldman Sachs providing this data to us today. Single stock liquidity is down sharply, and we've seen that from. This is defined as what tradable size as a percentage of market cap. We've seen that in big moves in equity markets, and again, that's a question of, well, did you need to hold a call on that? Probably not, but that is lower, whereas banks themselves very liquid at the moment.
I think that my reporting backs that up. I think the Treasury understands this, they know this, and they weren't particularly worried about it going into the call, and then heard exactly what they needed to hear in the call, which is there should not be reasons to be concerned about liquidity, and in fact, the bulk of the call was more about some of these other issues relating to the U.S. economy, and that's the big clarification. that I want to bring you from the senior Treasury official.